What exactly is happening to the stock of Kenari at the Nairobi Securities Exchange is what I want us to look at in details today. How Kenari stock is performing, any fundamentals around Kenari as a company, and even what the numbers are telling us in the market. We're going to look at all that in details. In case you don't know about Kenari or Kenya Reinsurance Corporation is one of the oldest institutions in the country in the insurance space and also among the oldest companies which were listed at the NSE. Kenari was established in 1970 through an act of parliament, but instead of issuing insurance to individuals, it does reinsure insurance companies in the market, and it has operations in Kenya and a few other African countries. Of course, worth noting is that the Kenyan government is a major shareholder in Kenari. So today we're going to dissect different aspects relating to share prices, valuation, any fundamentals as it pertains Kenari for you to really understand what is going on. In case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos about making money and investing each and every day. In case those are kind of topics which you like, down there is a button called subscribe. Click that button to subscribe to my channel, and while you still at it, drop a like on this video. Having said that, let's jump right in it and look at exactly what is happening to the stocks of Kenari at the NSE. Grab a paper and pen because we're about to have an amazing field day today. And also on my end, I'm going to be referring to my notes because I've written very many notes to analyze different things to assist you wrap your head around Kenari stock, and even if it is healthy, should you buy, should you sell, or what exactly are you supposed to do? The first thing I want us to look at is the share price, okay? And the summary of it is that the share price looks better until you truly zoom out. And I'm saying so because when you look at the current performance, the current share price of Kenari is going at 3 shillings and 51 cents at the NSE. Of course, this is a marginal drop in its share price on the most recent trading day, which was 24th of July. Simply put, yesterday, okay? That was a drop of 0.85%. That's marginal drop. More like a market correction if you look at it without really digging deep. And when you look at the 5 days average, the stock hasn't changed. It remained flat when you look at the entire week's performance. And now it gets interesting when we zoom further, because in 1 month's time, Kenari stock has gained 3.2% on its stock value. And then in 1 year, it has gained 59% over a period of 1 year. Okay? So far, that sounds very impressive. But now, here is where it gets very interesting when you zoom further out. Long-term price and performance of Kenari stock. Only 40% gain in 5 years. Please note, in 1 year, it gained 59%. But in 5-year duration, it only gained 40%. That tells you the period between 5th year and 4th year, really leading to the recent 1 year, things weren't that good, okay? And if you zoom further, in 10 years' time, it's lost 82% on its share price. Guys, that is about 80% below its listing price. This tells us something very important. The recent rally has been encouraging, yes, but it has not erased years of shareholders' value destruction. And that is the truth. If you just look at the share price maybe today, 1 week, 1 month, you'll be very excited. But those who have invested for about 10 years' time, their investment has corroded by 80%, which is something quite worrying, okay? Share price aside, let's look at the business. When you look at the business is still profitable, and the numbers in the financial statements tell us so. But operations of Kenari are under pressure, as you're about to see. And I'm saying so because when you look at the most recent financial statements from 2025, net profit of Kenari was 3.92 billion Kenya shillings. That sounds very healthy. But look closer, profit actually declined by 11.6% because the preceding year's profit was higher, and it declined because the insurance business itself weakened. Mind you, Kenari is in the business of reinsurance, but the insurance business itself did weaken. Therefore, profits did decline, and specifically the insurance revenue is the one that fell, and insurance service profit almost disappeared. Simply put, when an insurance company collects premiums, it hopes that claims and operating expenses stay way below the money it collected, right? That way it can be profitable on the insurance business. That difference is what becomes the profit. For Kenari, unfortunately, claims and operating costs increased sharply, therefore making its profit to decrease. That isn't the biggest of red flags, right? The red flag comes in something called combined loss ratio. Let me explain to you, because this is the biggest red flag when it comes to Kenari, something called combined loss ratio. And combined loss ratio is basically one of the most important numbers when you look at any insurance company, because combined loss ratio and its trend tells you if they are making profit or not based on the insurance premiums they are collecting and then the insurance claim and operating costs. Because if combined loss ratio is increasing, it means that they are paying out more than the premiums they are collecting, or even combination of the claims and the operating costs are really surging extremely high. For Kenari, in 2024, the combined loss ratio was 84%, And then in 2025, the combined loss ratio was 99.4%. It sharply rose to almost 100%. What this basically means is that in case Kenari collects 100 shillings from insurance companies, it spent almost 99.4 Kenya shillings paying claims and running the business. That leaves almost nothing from its core insurance operations. And this explains why the insurance service profit collapsed from nearly 3 billion in 2024 to only 108 million in 2025. A very huge deterioration, right? So you might be sitting there wondering, how exactly did the Kenari still make a profit of 4 billion despite collapse on the insurance profit? This might surprise many investors, but the answer is simple. Investment income. Kenari was able to increase its investment income by over 41%. And through that, the company earned 6.6 billion from investing its assets, right? This helped offset the weak insurance business. So, while the insurance engine struggled, the investment portfolio carried the business. This is good, but investors should ask a simple question. Can investment income continue saving profits every year? Because remember, this company is in the business of reinsurance. So if the insurance segment is not really bringing in huge profit, it's the investment segment bringing huge profit through the investing of the assets. Can that be sustainable? Having understood that, let's look at the balance sheet. How did the company fare on different aspects of the balance sheet? On the balance sheet, not everything was negative. A good number of things were positive. Some positives included assets increased to 72.2 billion Kenya shillings. Shareholders' equity increased to 54.5 billion Kenya shillings. And the company remained profitable. Capital continues to grow. This shows that Kenari is financially stable despite the operations challenges. And our hope is that it can be able to turn around these operations challenges for it to be very profitable across different business lines. And because of the profitability which I've spoken about, investors are still getting paid. And I'm saying so because when you look at the dividends which Kenari paid a dividend of 0.15 Kenya shillings per share, therefore resulting to a yield of 4.25% dividend yield, which is decent if you think about it, is a good entry point, And then when you look at the payout ratio, simply put, the proportion of the company's profit, net profit, what proportion is the company deciding to share with shareholders? Simply put, giving cash reward to shareholders for being part owner of the company. It did have a dividend payout ratio of 21%. And this matters because the company is paying a small portion of its earnings as dividends. That means that the dividends appear relatively sustainable unless profits deteriorate significantly. So in case the insurance profits continue going down, right, and then there is no income from investing activities, chances are these dividends are going to disappear. But as things stand, last year, the payout ratio was 21%, which is quite distant and also can be sustained in case the different business lines are profitable. Now, let's look at something also which is quite interesting. Simply put, valuation of the stocks of Kenari. Are they undervalued? Are they overvalued? Or what exactly is going on? The stocks look cheap, yes. Maybe too cheap. Are they cheap? Or they are valued well in the market? One reason that investors have become interested recently is valuation of Kenari. And I'm saying so because when you look at the price to earnings ratio or the PE ratio, the PE ratio of Kenari is 4 to 5 times its earnings. That is inexpensive compared to many listed companies. Even looking at the specific sector like insurance sector, that is way inexpensive, because normally a low PE ratio suggests one of these two things. Number one, either the market has overlooked the company, okay? Or secondly, the market expects future problems. And the question now is, which one applies to Kenari? Has the market overlooked the company? Therefore, Kenari's stock is severely undervalued, because typically the PE ratios are normally upwards of 10. Kenari's is somewhere 4 to 5% depending on the share price you are pegging for you to do analysis. So, is Kenari being undervalued in the market, or the market expects future problems? I think it's a combination of both, because at the very end, you're going to also see the risks Kenari is experiencing right now and have been prolonged for some time. And the biggest risk in the room is governance. Governance of Kenari has become a big story, and in fact, bigger than its earnings. And the governance issue of Kenari is very complicated because of two things. It's hitting both management and the board of directors. Starting point with management, there have been recent CEO controversies at Kenari, and even just Google the CEO of Kenari, Dr. Hilary Maina. He's been going through some crazy dynamics, court cases after court cases, and the CEO controversies and court petitions are also events which are sending signals to the market, because there are allegations around, for example, involving management malpractices, and also there is issues around the government removing several directors. And these happened against the backdrop whereby earlier in the year, around February, when there was a holding, Kenari did vote to enable the government of Kenya to have control over the board. And we've seen news around the government really ostering the directors. Even a recent example, just 3 days ago, the National Treasury did oster 4 directors at Kenari. That tells you the government is having power to oster these directors, and of course, the power bestowed to government in the most recent holding, which happened about 7 months ago. So whether these allegations relating to the CEO and even dynamics around the board are true or false, ultimately they are introducing uncertainty in the market. And unfortunately, the stock market really hates uncertainty. They rather know very well the CEO has been removed or the board has been removed. They are replacing with a substantial CEO instead of dealing with uncertainty, ongoing court cases, because large institutional investors really dislike uncertainty, and the market at large dislike governance risk even more than temporary earnings weakening, because governance risks shows lack of trust in the company. It's better even for the earnings to dip a bit, the market adjusts, then they continue forging forward because management is solid. But now think about a situation where there's trouble at the CEO level and also trouble at the board level. Those are the realities of Kenari as a business. So, despite all this, why has the share price still risen nearly 60% this year? It's because of possible reasons. Number one, investors seeing value after years of underperformance. Remember, I told you in 10 years, Kenari has lost upwards of 80%, okay? So it's been recovering. Secondly, the extremely low valuation. Some investors invest knowing very well upon price correction and the market really reflecting the intrinsic value of the security or the share, the prices are going to go up. Third thing, there's improving investment income. So some investors out there are confident with the improving investment income, Kenari might be able to continue sustaining the profits. Then the fourth thing is that expectations around operational performance could recover. That's also something that investors are pegging on. And then the fifth and last thing is the dividend support. The company is still paying dividends despite the ongoing challenges. And because of this, sometimes the market begin recovering before financial statements fully improve. Therefore, there is that trend in the market of the share even increasing despite these prolonged troubles I've spoken about relating to Kenari. So as I conclude this video, should you buy, should you sell, or should you wait? In case you are an investor in Kenari or want to get to in Kenari, let me give you the reasons for all this. Each of these categories, reasons which you could consider. Reasons to buy. The first reason is very low valuation. It is undervalued. The securities, the share is undervalued in the market. Secondly, strong balance sheet. Third, profitability. Beyond looking at the individual business lines, overall Kenari is profitable. Fourth, dividend paying. Fifth, potential upside if insurance margins recover because that's the core business. And then sixth, government backing may provide long-term stability. We've seen for companies where government backs, for example, even KQ, other companies, it typically provides some long-term stability. And then reasons for you to be careful in case you are looking at a stock of Kenari. First and foremost, insurance operations weakened significantly because you saw a drop from billions to about 108 million in profits from the insurance segment. Secondly, the combined ratio almost reached 100%. That is quite troublesome, more so in the insurance sector, because it means the collected share premiums, most of them, almost entire of them, more so in the case of Kenari, were utilized in paying out claims and running operations. Then the third reason to be careful is earnings have been declining. And I'm talking about the EPS. EPS has fallen for 3 consecutive years. And that's so because the EPS or earnings per share in the year 2025 was 0.7 Kenya shillings or 70 cents. In the year 2024, it was 0.79 or 79 cents. In the year 2023, it was 1.78. That tells you EPS has been declining over the past 3 years. That's also a trend which deserves attention. And of course, governance uncertainty could also weigh on investors' confidence. So these are some of the reasons for you to be careful. Final verdict. In case I'm to make a decision as to whether to invest in Kenari or not, because it has mixed signals, okay? Some fundamentals are very solid when you look at, for example, the financials, okay? There is issues around governance issues, both at management level and the board, you name it. There is a decline in EPS, but then again, the company is ramping up profits on the investment side. So if I was to make a decision, I, as an investor, this is my personal opinion. I'm not saying you have to abide by this. This isn't financial advice. This is my opinion. I would evoke something called wait and see on that particular stock. And this so because the valuation is simply too attractive to ignore, okay? But also, I wouldn't rush to buy aggressively. I'd evoke something called wait and see. In that, if I already was owning the shares, okay, I'd continue holding while monitoring upcoming results and governance developments. Because over time, the hope is that these governance issues are able to be improved, and even so performances financially continue going on the upward trajectory. And then if I wasn't owning the shares, I'd consider accumulating gradually, right? Only if I'm comfortable to risk a given amount of money, given already the business is having some risks, okay? So I'd accumulate to the extent I can, but gradually, not to wake up and say, for example, I have 20 million, I'm putting 18 million on Kenari stock. I'd go slow but sure, okay? Our hope is that in the next financial statements, we'll see how things are going to change. But I think the next financial statements are going to be critical in really informing if investors are going to go all in on Kenari, or even they're going to be mass exit of investors from Kenari stock. What do you think? Do you have stock of Kenari? Are you going to continue holding, or are you going to sell? In case you don't have the stock of Kenari, are you looking to buy? Which of the two options do you look to evoke? Comment down below in the comment section. Let's continue discussing there. But this analysis of Kenari, I find it interesting because it is an interesting company which has a mix of everything, both negative and positive, which can quite spin an investor if they don't really understand what is going on in details. I hope you got a thing or two from this video. I look forward to share with you other amazing videos next time. Bye bye and take care.